Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're looking at some intriguing findings from the Bank of Canada's fourth quarter consumer sentiment survey. Despite concerns about a potential recession in 2025, Canadians' intentions to buy homes are on the rise. The survey highlights that nearly half of Canadians expect a recession, but this has not deterred them from planning to move. In fact, 22.4% of respondents indicated a greater than 50% chance of moving to a new primary residence within the next year. This is up from 21.1% in the previous quarter. The survey also shows a growing interest from renters, with 19.9% considering purchasing a home in the next 12 months, compared to 16.9% last quarter. The Bank of Canada attributes this rise in home buying intentions to expectations of further interest rate cuts in 2025. The report notes that consumers are seeing and expecting easier credit conditions, which supports these intentions. However, the timing of these home purchases remains uncertain for many. Those planning to buy a home over the next year anticipate only about a 50% probability of actually following through with their plans. This uncertainty is part of the broader economic picture, where nearly half of Canadians still foresee a recession, and many express uncertainty about the economic direction, especially with global tensions influencing perceptions. Interestingly, the survey also indicates that inflation expectations have largely returned to pre-pandemic levels. While consumers' expectations for food and gas prices remained steady, expectations for rent have eased, although they still anticipate rent will rise faster than pre-pandemic levels. This improving inflation outlook is encouraging consumers to express strong intentions to increase spending on essentials and housing over the next year, with many anticipating their spending will outpace price increases for the first time since 2021. On the business side, the Bank of Canada's Business Outlook survey shows cautious optimism among businesses, despite subdued sentiment. Conducted during the U.S. presidential election period, the survey found that 40% of businesses expect negative impacts from the new U.S. administration, while a third remain uncertain. Businesses report continued soft demand due to cautious consumers, though sales expectations have improved slightly above the historical average. Labor and capacity constraints have eased, with many firms adopting a wait-and-see approach, planning to maintain stable employment. While wage pressures are expected to ease, some businesses anticipate passing cost increases to consumers, with 20% now expecting inflation to exceed 3% over the next 2 years, up from 15% last quarter. In a research note, TD economist Maria Solovieva highlighted that investment intentions have picked up, particularly in the energy sector. While rising expectations for future sales suggest businesses remain on solid footing heading into 2025, there's a sense of tense anticipation, with the looming threat of tariffs being a common concern throughout the survey. Now let's take a closer look at recent data released by the Canada Mortgage and Housing Corporation. The CMHC reported that the total number of housing starts in 2024 increased by 2% compared to 2023. This growth was notably driven by increased starts in Alberta, Quebec, and the Atlantic provinces. In total, housing starts reached 245,120 last year, up from 240,267 the previous year. However, it's not all positive news across the board. In Canada's 6 largest census metropolitan areas, there was a combined drop of 3% in housing starts for 2024. This decline was particularly evident in Vancouver, Toronto, and Ottawa. Meanwhile, cities like Calgary, Edmonton, and Montreal experienced a rise in housing starts last year, contributing to the overall national increase. According to CMHC's chief economist, Mathieu Leberge, although the annual increase in housing starts marks some progress, a significantly higher supply growth is still needed to restore affordability in urban centers. Canada is projected to require an additional 3.5 million housing units by 2030 to return to the affordability levels of 2004. This is on top of the 2.3 million units already expected to be built. In light of this, CMHC had estimated last spring that Canada could potentially build up to 400,000 new housing units annually based on the current resources allocated to residential construction. However, the need for a substantial increase in housing supply remains a pressing issue. TD economist Mark Erkelau pointed out an emerging divide between Ontario and other regions of the country. Despite national housing starts running at a high level, Ontario has seen a decline, particularly in the condo sector, which is facing weak demand. Erkelau noted that further declines are anticipated in Ontario due to cooler population growth, which may lead to a pullback in Canadian housing starts in 2025. The CMHC report also highlighted a sharp drop in the seasonally adjusted annual rate for housing starts in December, which fell by 13% to 231,468 units compared to 267,140 units in November. CIBC economist Catherine Judge described this as a significant drop, falling well below the consensus expectation of 250,000 units. Despite this, the fourth quarter overall still saw a 4% increase over the third quarter. Judge also mentioned that while building activity is expected to increase in line with falling interest rates, the acceleration in housing starts may be limited by the ongoing weakness in condominium presales. The report indicated that the annual pace of urban starts in December fell by 14% to 214,000 units, with multi-unit urban homes such as apartments, condominiums, and townhouses dropping by 15%. Meanwhile, single detached home starts fell by 10% to 45,485 units. In rural areas, the seasonally adjusted annual rate of housing starts was 17,468 units in December. This data paints a complex picture of the housing market in Canada, with both positive and challenging aspects to consider as we move forward into 2025. Let's turn our attention to the latest data from Statistics Canada, which reveals a noteworthy trend in household debt. Despite a slowing economy, Canadian households are not shying away from borrowing. In fact, the growth of household debt accelerated in November, driven primarily by an increased demand for mortgage credit, which has picked up over the past year, though it remains below historic levels. The outstanding balance of Canadian household debt climbed by 0.4% in November, reaching $3.03 trillion. This represents an annualized growth of 3.9%, the highest level since May 2023. While this uptick in borrowing is significant, it's important to note that it remains well below the 5-year average annual growth of 5.0%. Most of this debt is tied to mortgage loans, and they are the main contributors to this mild acceleration. Residential mortgage debt increased by 0.5% to $2.25 trillion in November. This monthly growth is higher than the 0.3% growth seen last year, and has been consistently in the 0.4 to 0.5% range since May 2024, following the central bank's first rate cut. Over the past year, households have been accumulating mortgage debt at a quicker pace. The annual growth rate hit 4.0% in November, marking the third consecutive month of acceleration, the highest since June 2023. There's a renewed appetite for mortgage debt, although it is still lower than the 5-year average growth rate of 6.6% for this segment. Conversely, growth in non-mortgage loans is slowing down. Canadians are showing less interest in other types of loans, with non-mortgage credit advancing by just 0.3% to $779.07 billion in November. This is about half the monthly growth rate seen last year, and annualized growth has slowed to 3.7%, returning to levels last seen in August. This trend suggests a potential issue for Canada's economy, which heavily relies on real estate. Such economies often see residential investments drawing resources away from other areas, resulting in a lack of diversification and increased vulnerability to economic shocks. Despite warnings from organizations like the Bank of Canada, policymakers have continued to focus incentives on growing mortgage credit. While preserving high growth levels might seem beneficial in the short term, it can exacerbate the problem of a housing-dependent economy in the long run. This focus on mortgage credit may lead to a temporary period of growth, but ultimately, it creates a less stable market, highlighting the need for a more balanced economic approach. In our final segment today, let's take a moment to delve into a fascinating piece of Ontario's history that's currently on the market. A historic farm in Caledon, Ontario, featuring a quintessential Ontario Gothic farmhouse, is now for sale with an asking price of $10 million. This property, located at 14,650 Heart Lake Road, is steeped in history, having remained in the Smith family for over a century. The farm was originally purchased in 1855 by Andrew Smith, who acquired the 100-acre property. Later, in 1864, it was passed down to his eldest son, Alexander, who built the farmhouse that stands today. The house is a classic example of the Ontario Gothic style, characterized by its L-shaped floor plan, polychromatic brick patterns, and distinctive architectural features such as buff brick quoins and voussoirs. Among the unique attributes of the farmhouse are its polychromatic end chimneys, a projecting bay window, and decorative barge boards on the wraparound porch. The property also includes a brick summer kitchen and a carriage house, complete with the original farm bell on its roof. Notably, the farmhouse has been modernized with solar panels, adding a touch of sustainability to its historical charm. The property spans approximately 50 acres and includes 5 barns, a cottage, and a log house near a pond. These barns are not just relics of the past, but offer significant potential for income generation. They could be transformed into event spaces, conference centers, or even wellness retreats. Some of the barns are already equipped with chairs and tables, ready to host gatherings. Additionally, the land offers the opportunity for various agricultural ventures, such as a lavender farm, which could yield substantial profits depending on the use of the lavender. With the potential for diversified income streams and its rich historical background, the property presents a unique investment opportunity. The initial listing price was nearly $12 million, but after more than 100 days on the market, it has been adjusted to just under $10 million. While this may seem steep for a property in Caledon, where homes typically sell for much less, the combination of historical significance, potential income, and the sheer beauty of the estate make it an intriguing proposition. Whether you're drawn to its historical allure or its future potential, this Ontario Gothic farmhouse offers a rare glimpse into the past while providing opportunities for the future. It's properties like these that remind us of the rich tapestry of history woven throughout Ontario's landscape.